Diane Swonk with us, Mesirow Financial. As we look at gold, bring it up here. Bring up this chart right away. And Diane, we're just going to put up nominal gold. Absolutely remarkable. There it is. This is just a gold price, and it goes back just before the surge. Rather, just after the surge in the early 80s. Diane doesn't remember that. And we went along like cheap gold.
I'm old enough.
In 04, boom. Diane, help us here. One, what does it signal to you that gold is at $1,500 an ounce?
You know, I don't look at gold because I don't see the fundamentals in it, but I do think it is a huge indicator of uncertainty out there. And I think we've seen this year, we started the year on a little bit of an optimistic note, hoping many of the uncertainties that were the headwinds of recent years would abate, but they keep coming back, and they come back even stronger. We still have a lot of uncertainty in Europe and their debt situation. There's uncertainty about the U.S. political will to actually bring down our deficits. China now saying we want protection as one of your biggest lenders in terms of the debt situation. So there's a lot of uncertainty out there, and then you throw in things like earthquakes and everything else, and what's going on in the Middle East, that now subsidies in the Middle East that they're having to pay off many of the places like Saudi Arabia, heavy subsidies on food and oil are now costing them more, so they need a higher oil price to justify it. I mean, all these things I think are really what's reflected in gold rather than just inflationary pressures. I think this is more of a, I'm scared, I don't know where to go.
Matt, come back here to this chart again. Let's ignore gold. Matt's there with their furnace is on. They're making gold. Let's ignore gold. Diane, I get so many emails from listeners and tweets. Why do economists, led by Chairman Bernanke, ignore gold? Do they ignore gold because they theoretically ignore it, or do they ignore gold because it's the great unspeakable?
Well, gold is so silly in terms of we don't buy gold every day. It's not part of inflation, and it's actually been the wrong indicator on inflation in recent years. It's been going inflation when it was decelerating. We saw gold accelerating. So it really has been more of a confidence measure in the market. It's very inconsistent measure in terms of an indicator for inflation, and it's not a component. I mean, how much gold do you buy a day? How much gold do you use a day? How many industrial uses are there for gold? There's just other commodities that are much more powerful than gold that actually have fundamentals behind them.
Diane, let's listen to this. Earlier this morning on Bloomberg Surveillance, I spoke with Mohammed El-Arian of PIMCO, and I asked him if the rumor that PIMCO is buying treasuries is true. This is like Business Insider and Politico. Is it true?
I have no idea where that came from. Okay. So as far as I know, we're not, and I should know.
Well, he should know. I guess there it is. Mohammed El-Arian. I mean, Diane, we're down to where gold's up. Bill Gross says lighten up on treasuries. I mean, this cacophony of uncertainties, and then you overlay it on your economics of bringing down GDP in the first quarter. Where's the confidence for second, third, and fourth quarter if Mohammed El-Arian has to deny rumors about buying treasuries?
Well, you know, I mean, the issue on treasuries is a much larger issue in terms of we've been in sort of a 20-year bond rally, and, you know, we're at a point where the Fed is actually trying to reflate the economy, bring up core inflation because it was too low. And so when you start to look at it from that concept, you know, of course, treasuries should be going the other way. And then you add on the uncertainties about the budget deficit, and you can certainly see that along with what's going on in Europe. I have a lot of questions about why the euro is, you know, it's a carry trade of why it's so strong relative to the dollar, but given the sovereign debt situation in Europe, I have a lot of concerns about that, too. But all of these things together do suggest to higher Treasury prices and that we probably have passed a low, even though it was amazing yesterday with the S&P shooting their, you know, bullet over the bow sort of as a warning shot on deficits in the U.S. that we didn't see Treasuries go the other direction and back up.
Critically, Diane, when you look at the 18 degrees you have from University of Michigan, go blue, and when you look at that and you say, okay, interest rates are going to go higher at some point, Diane Swonk, Bill Gross, and many others, is it a smooth transition to a higher interest rate regime, or is it a jump condition?
It's an absolute jump condition. That's the problem, is that, you know, you're going to see fits and starts because we've seen this uncertainty. People still run to the Treasury market for safety, and sometimes in this uncertainty as well as gold. So it's kind of interesting to see that the U.S. still has that reserve currency status out there, and we've got so many bumps along the road that I think it's going. You know, the Fed's not going to be raising interest rates anytime soon. As they slowly back off of QE2, we've still got a lot of bumps in the road, slower growth, a lot of crosswinds in the Treasury market. So although the trend is on the upward downward pace. It could move very rapidly if we saw a major drop in confidence in our ability to rein in deficits. That may be a 2-year out phenomena. It may be, a 3-year out phenomena, but it's coming. And we know that the trend is moving there. And as economists, we can't time the day in an hour or minute, although,
Right.
if we could, I guess we'd be about as accurate as weather forecasters. So, we just can't do it.
Diane, it's Extrapolation Tuesday, and here's mortgage debt outstanding. Bring up the chart here, and you can see here. Let's consider our animal spirit. Okay, so Diane, we got a trend from 1985 to 2002, and then we got a surge in mortgage debt outstanding, and the real headline here is we barely rolled over. I mean, we got a long way to go to get back to mean on mortgage debt. Is the animal spirit, is the appetite anywhere near for the housing market, or is it out another decade or out another 5 years?
Well, I don't think it's out another decade, but it's out for another while. And I think, Fannie Mae shot a warning shot out. They tweeted today that they were very concerned about hitting a pocket in the economy with the housing market being very weak. The bottom line is, how can you possibly see mortgage debt come back when you wiped out a shadow banking system that largely provided that of $10.5 trillion? The hurdles to buying a home now are getting harder and harder. And even refinancing. Talk to anyone who's tried to refinance. I have, and I did successfully, but I couldn't believe what I had to jump through on a house that I have a lot of equity in. I hardly own anything on it. I mean, it's just amazing how difficult it is because banks, there is no secondary market besides Fannie and Freddie in the mortgage market. And, the hurdle just to get a home, you got to have 20 to 30% down now, and that's standard.
I mean, Diane, this is critical. I don't know where we are in time, but Diane, this is critical in that you said refinancing. I heard the roar in my ear from the control room because they're all in the same thing. Rex lives in a trailer park, and Rex is like my producer. He's like, he can't get a refinance. I mean,
well, if you live in a trailer park, that's kind of understandable.
Most of America can't refinance. I mean, seriously, we're making jokes about this, but this is dead serious. What do we need to do to get America to be able to refinance?
Well, it's amazing because even if you qualify, it is incredibly difficult. You've got equity in your home. And so we got about a quarter of mortgages out there. Mark Zandi estimates that are underwater. Where's the rest of them that we could refinance on? Now, mortgage rates are not as low as they were during their big low part when we did have a refinancing boom. But still, many people could at least try to refinance to these. I mean, these are going to be gifts. We'll look at these rates 10 years down the road, 5 years down the road and go, God, we got a 30-year mortgage rate at what we're seeing right now.
Right.
It's unbelievable. But yet you can't get it because the banks don't want to hold the debt, and there isn't a secondary market strong enough for them to do the refi.
Diane Swonk with us from Mesirow Financial. Diane, I want to get to you quickly on car sales because I know you follow that carefully. Diane, it's sort of a V-shaped recovery. You got 14 million units for 2012. Can it be better? I mean, sales are good, right?
Sales are, coming off of extremely low levels. They're good. Everything's relative in this recovery, right? When you lower the hurdle low enough, it's easy to clear. But let's put it into perspective. The auto industry is one of the few industries that rebought their captive finance companies, which means they're actually issuing subprime debt again. They are selling cars to people who are not the most creditworthy, but are still creditworthy out there. And that's one of the few places where credit markets appear to be working again. And so, lo and behold, where do you see the activity at?
Critical question then. Let's rip up the script here. This idea, Diane, that they're redoing a subprime market, are you suggesting other parts of our economy should be supported by the government so they can do a redo of the subprime market, or are the auto industries getting themselves into trouble again?
I don't think the auto industry is getting itself into trouble again, and no, I don't think the government should get into the subprime market again. But I think we've already been in that market. Thank you very much. But I do think it's interesting that where you do have credit availability for not just the most creditworthy of clients. We're not talking about people who don't have any jobs or income here that they're selling cars to. We're talking about something below $200,000 or $150,000 in terms of household income selling a car to. That's a little more reasonable. So I think it's very important. The other issue is, remember, the auto industry, we were scrapping vehicles faster than we were buying them for several years. So the pent-up demand here is really pretty high, and it's getting very difficult to keep the existing vehicles going. That said, the average age of vehicles on the road has gone up quite dramatically. But we have seen, as gas prices have gotten higher, some shift back into small cars and used cars again.
Right.
So this recovery in vehicles, it's a high-income phenomena. It's hitting a little more into middle-income households because they have credit. But what kind of car they buy may not be as profitable for the automakers going forward.
Let's look at the number quickly, folks. I want to get two ideas in here with Diane Swonk. The number, and you can see here, it's debt per capita, 45,000 versus 20,435 10 years ago. That's remarkable. Diane, you're concerned about Europe. Bring up an elegant chart. When you look at the Greek yields at 20%, we're going to show this chart later as well. Here's credit default swap spreads. Greece, Spain, and USA. I mean, why should we care about those spread widenings, whether it's modest in Spain and substantial in Greece?
Well, certainly, what's interesting in Europe is how the Europeans all say they've got on their balance sheets of their banks that Greek debt held to maturity. We know there's going to be restructuring and they're going to take a haircut. The banks are. And, the ECB is handing out bailouts to Portugal at the same time they're raising rates. It's kind of an interesting dimension, very different from the U.S. phenomena. I think, the real critical issue is Spain, as long as we don't get contagion to Spain, because that's where the biggest exposure to debt is in the European banking system, and we just can't handle the contagion from the European banking system. We would have a lot of problems here in the U.S. as well, and that could spill over to us. So that's what my concerns are. And it's why Germany has no choice, whether the political backlash is there or not, but to continue these bailouts and fund the bailouts. The German taxpayer is on the hook.
Diane, 30 seconds left here. What's your GDP call now for first and second quarter? Have you marked yourselves down sub 2%?
Well, currently I'm at 2.1, but it looks like the data is coming in a little shy of that, probably 1.7, 1.8. On the second quarter, 3, 4, 3.5. Maybe I am a little bit concerned about some of the headwinds we're facing with higher energy prices, because those don't look like they're going to go away anytime soon. And then we're hitting a tipping point on demand. 385 a gallon regular national is what most of the people in the industry on the retail side tell me. They start seeing a major tipping point.
Oh, great. Let's leave it there. Diane Swonk, wonderful. Thank you so much.